If you're entering too early, getting wicked out, or doubting every point of interest you get involved with, it's probably because you're not using this candle. You see, the outside bar isn't just a wick, it's a rejection. It's the moment when smart money steps in and says no more in this direction. In this video, I'm going to show you how this candle confirms liquidity sweeps, validates order blocks, and filters out the bad trades if you know where to use it. So without further ado, what will you learn in this video? 1. What is an engulfing candle and why does it matter? 2. How to spot it after sweeps of liquidity. 3. How it confirms valid order blocks. 4. When not to use it, especially in mid-range chop. And 5. How to use it in combination with order blocks and correct use of market structure. You see, to understand how an engulfing candle works, we first of all need to look at the components of a single candle before we can look at it next to another candle. As we can see with this candle being a bearish candle, we have an open, a high, a low, and a close. Now, when you put that next to another candle on the left, what we're looking at doing is engulfing the previous candle. Sometimes this can be called an outside bar, but generally speaking, it is known as the engulfing candle. And the reason for that is that you've typically got, in a bearish setup like this one, the high completely engulfing the previous high and the low completely engulfing the previous low. Now, in the inverse, all what we have is the open, the close, the high, and the low, all again engulfing the previous candle. Now, you just need to think to yourself, what does this engulfing candle really represent? What is it showing you on the charts? It is essentially showing you a shift in power. Now, using this bullish example, what we can see right at the bottom is a sweep of liquidity. We have got the low extending lower than the previous candle, followed by the high and the close also finishing above the previous candle. That would indicate that you have had a sweep of liquidity, which is all the buyers and sellers, the exchange below the previous candle, have been taken out by this engulfing candle, and we are starting to shift the market upwards. And when used in the correct place, it can be used to signify a massive shift in the overall trend direction. So moving over to a real chart now, we're going to look at, first of all, how to spot them after sweeps of liquidity. We are going to be looking in particularly at this candle, and we are also going to be looking at this candle here after an order block had been formed. Okay, so just going to mark out the order block as standard, which is a typical way as to how I trade. And we're first of all going to be looking at the sweep of liquidity. Okay, so liquidity is pretty much indicated by the supply and demand coming into the market. You can see essentially where a huge exchange of orders has taken place within this last push up candle and then an aggressive push down. So we'd left behind a very, very small area of imbalance just in here. Price had to come up, mitigate this area. It rejected, it pulled away again. Another area of supply came into the market, went all the way down, worked its way up, indicated that we've got some sort of inducement in the market, which again supplies liquidity in the form of stop orders and buy orders just above here, where people thought that this was going to be the drop point. They got tagged into a trade, became the blocked orders, and then price came up. What this had done as it was forming the engulfing candle was we had ended up sweeping liquidity from this inducement candle and also from the previous high of that candle, at the same time mitigating this order block at a deeper level than before. So what happens after that? The candle essentially ended up becoming an engulfing candle and it just aggressively dropped off from there. Okay, so this happens over and over again. And the key makeup to make a very good engulfing candle is if you can get a sweep of liquidity and a mitigation of a previous order block. Now, this is how you can use an engulfing candle to validate or confirm it being an order block or an area where price is possibly going to come back to in the future and react from. Okay, so just following the bullish structure, which we have here, we have the price pushing up, price coming down, struggling to break past the highs, a further more aggressive push down, then a push up with the engulfing candle for a minor pull down, and then further back up. Okay, so in this general scenario, what you've got is a huge engulfing candle forming right before the break of a previous structure. So if we think of this being a boss high, even though this candle doesn't break the highs, it is really the last significant push before the break. So for me, this would validate this area becoming an order block for the future, despite it being in the middle of a range. So if we carry this across, I would expect that price is going to react from it somewhere in the future and possibly get you a trade. It isn't always the case, especially when you are targeting a mid-range order block or a mid-range structure, but quite often you will have the chance to get involved in a trade. Okay, so in this scenario, if you had taken a trade from what I recommend is the 0.25 of an order block and feed it to the last significant high, you would most likely get a trade out of this. You would take profit before you get another engulfing candle forming here, where again you can start looking to short when price returns to it again. So price has pushed up. There's another engulfing candle right here. I wouldn't recommend always taking these trades, but you could take the last candle. In that case, it wouldn't have hit. If you took the last significant push up, it would have hit. You see these sorts of patterns happen over and over again. Even with our previous example over here, the order block for over here, price came in, it mitigated, it didn't mitigate by the 0.25, which I tend to use. Price then had the incentive to come back inside of this order block area, mitigate by the 0.25, and then even though price had returned back into this order block, which was confirmed by zapping the energy, just think of it taking the liquidity out of here, which had taken it out of there, which had taken it out of here, and had taken it out of there. It's basically transferring the energy or all the orders over to here, which can now be classed as its own order block. And I would tend to pretty much, when you've had a mitigation like this, I tend to look above the wick which came in and look at what's left. And then if you feed it along, you've got again another nice mitigation, not quite an engulfing candle. Therefore, we don't break the previous lows on this push down, but it just gives you ample opportunities when you are lining it up from order block to order block to order block, and just understanding that the engulfing candle is really trying to show you a shift in the momentum of the market. Now, I just want to take you through an example or two of when an engulfing candle can become an order block when it is just before or just after a significant break in structure, and that is usually a boss or a choke. So we're just going to move the chart along now and just sort of follow the trend. Okay, so price is finally pushing up, breaks above this area, keeps on pushing up, pushing up, pushing up, and then we get to this area. Okay, so if we look over on our left, we have a standalone pin bar, which is going to be a significant area which a lot of people are going to be looking at. We have cleared all of this sort of movement down here on the charts. Price has come in, it hasn't quite mitigated the order block, but it has come down and created a bearish engulfing candle. Okay, so just bear in mind that a lot of people here are thinking that this is close enough to being a mitigation of that order block and we're going to continue the trend down. So this is how I determine there are trapped orders. We have a bearish engulfing candle, can't place a trade off of anything just yet. Okay, we ended up not closing below the open of the previous candle, which was bullish, but then we had this significant push straight through that order block, invalidating it. Okay, so in here, there are clearly a load of trapped orders, which may well be an area for price to react from later down the road. Okay, so I'm just going to move along and see if price did come back to it. Okay, so price came back to this area because it was pre-major structure. Okay, so it was pre-major structure. It was looking at the order block. It was just before the order block. They are trapped orders. That engulfing candle has become an order block of its own. Just think order block is blocked orders, people stuck in the wrong direction, or banks looking to work their way through in the way which they trade. So what happened here, we got a nice deep mitigation and price had, don't know where it goes from here, come up, bricken this new structure, and we can start looking again for further trade entries where there may have been order blocks formed in the form of engulfing candles. So I would assume this part here, this bit, oh, got the wrong one. This being an engulfing candle, of course, price has reacted and come back. Did price come to it? Very, very nearly. Okay, so if I had marked up that final structure, it would have been fine. So again, it just happens over and over. Okay, relatively simple. But there are some key areas where you don't want to be getting involved with an engulfing candle. Now, there are a few areas where you don't want to get involved in trades using engulfing candles, and they are typically when there is a lot of chop in the market. And what I mean by that is when the market is condensing. An engulfing candle is showing you a significant movement of pressure in one direction. Now, this is the only candle out of this whole area, to begin with, at least, where you may be forgiven for trying to find a trade out of here. However, as the market evolves and it moves on, you can see that price is not returning to this area, but it is starting to form into a very condensed area, which I tend to try to stay out of with any of my trades. Now, there's an engulfing candle here, there's one here, there is one here. There might be a couple of which I've missed, possibly this area too. Yeah, so there's one there as well. There's one here, and there is also one here, all of which would have failed. So how do you know to stay out of these areas? Just have a look. Okay, it's as simple as that. The market is trending upwards with a fair bit of momentum. Okay, the market had been moving all the way along here when we decided about this area coming into a significant area, a structural shift, an order block. We'd spotted this engulfing candle form. It made sense. As we move further up into the market, all what we're doing is we're starting to consolidate. Okay, so when the market is doing this, just don't use any of the candles. Whether or not you're looking for pin bars or if you're looking for engulfing candles, don't really look for anything apart from on the outside of this sort of choppy area. And the reason for that is the market is starting to stack orders in both directions. You've got wicks on the bottom, you've got wicks on the top, you've got nothing of substantial sort of movement going into the market in any which direction. The best chance that you're going to have is wait until there is a sustained breakout on either side. But essentially, stay out of the choppy areas because you will be chopped up. So let's come back to our previous example of where you could get involved using an engulfing candle and recognizing that as a order block or blocked orders in the market and how to then get involved and get a successful trade away. So let's think of just the general structure of what's happening in the market. We've got an upward trend, we've got a pullback, we've got another push up with an engulfing candle. See, we've had a sweep of the lows, we've ended up sweeping the highs of the area. Market's pushed up, pulled back, and then it finally gets involved within this order block area. And then chances are the market is going to push off again to continue its trend in direction. So when you think about the general constructs of what we've got, is we've got an area where the market had hesitated. This might have been a reaction to another point of interest over on the left somewhere. That's usually a good indicator because when you think of it, the market tends to react from supply and demand areas, which are previous support and resistance areas in a lot of cases. So if we've got something which we're reacting from over here and market pulls back, then we get an engulfing candle to break through this whole area. Then we start to pull back, get involved, create sometimes another engulfing candle, which means that we could line up for another trade in the future. Okay, something like this until it starts running out or the market just carries on shifting in the direction that you want it. So let's just have a look at the live charts again and see where this has taken place in reality. Okay, so here is a prime example of the same sequence of events as what we've just drawn out. So right here, we have an engulfing candle causing a massive drop in the market. So huge amount of supply coming into the market. And we get a pullback about halfway. Obviously, at this time, you don't know that's halfway, but you get another engulfing candle, which is immediately rebalanced, typically taking a lot of the strength out of the engulfing candle itself. So If I was marking this up on my charts, I wouldn't necessarily be looking to take a trade from here. It's something which I'd drop down possibly on a lower time frame to see if there's a rejection, but I wouldn't look to set a pending order. Now, as price does come through it, it does hesitate, and then it creates yet another order block using an engulfing candle. Okay, so there's another engulfing candle which forms right here. So at the moment, we have three of them. We've got one drop in supply into the market to drop the price. We've had a break of structure right here. We had another break of structure right there, so allowing this to form into an order block, but as I said, it's been rebalanced already. We have the inducement heading towards it. Price does break through, and then it finally pushes up, and we end up getting another break of structure, leaving behind an imbalance after a sweep of the low and a push up. Therefore, you have a trade to get involved with. And if you get involved on the 0.25, as previously indicated, put your stop loss just below and then feed it to a significant target. Okay, so take out a swing high potentially. So away you go. So that's typically how you would use an engulfing candle to your advantage. Okay, it's just part of the many setups that we tend to trade over at FTR. And if you're interested, feel free to add your name to the waiting list. I let people in on merit, not based on anything else. So fill out the questionnaire. And if this video was useful, then you're going to want to watch the next one, which is going to help you trade reversals and rejections and increase your win rate.